we're going to work on the cash budget. We're going to talk about how sales and collections differ, how expenses and payments differ, and how to get to that cash budget. You probably remember from your Principles 1 class that what you earn, your revenue, is not the same as your collections. That you can get the money from the customer before, at the same time, or after you deliver the product or the service. What you incurred, the expense, what you used up, doesn't necessarily happen at the same time as the payments. You can pay in advance, like with an insurance policy. You can pay at the same time, like when you pay for a hotel room, or you can pay after when somebody sells you something on credit. This would be a good time to stop and review the tutorial on cash versus accrual basis to review the difference between revenue and collections and expense and payments. Because if that's not clear in your mind, this cash budget will not be clear in your mind. So let's start with sales. When will you get the cash? Some of the cash you'll get now for cash sales. Credit sales, you'll get the payments later. Well, how much later? Well, firms examine their history to predict. So let's get an example. Here would be one firm. They get about 30% of what they sell in the month that they sell it. They get 40% the next month and 25% in the second month after the sale. Now you may notice this does not add up to 100%. Anything that was uncollectible, bad debts, would just not be budgeted as incoming cash. So let's review how this might work. Here we have cash and credit sales for 2 months, January and February, and the total sales. And we want to get a collections budget. So the collection budget would have 2 pieces here. The cash sales are easy. That will go, the January cash sales will come in January. The February cash sales will come in February. But that $20,000 in January is going to be spread over 3 months. Some of it's coming in this month, some next, some the month after that. Same thing with that $40,000 from February. Some in February, some in March, and some will be in April. And so our collection budget is going to show the stagger. It's going to show how the collections are paced out over time. So how did we get these numbers? So the $6,000 came from the $20,000 times the 30%. The $8,000 came from that $20,000 times the 40%. And then in March we would get the last 25%. That would be the $20,000 times the 25%. And the final 5% we don't show in our collection budget because we're not sure we're going to collect it. February collections for the credit sales, this $12,000 came from February sales times 30%. The next month would be that 40% times the 40,000. Of course, the cash sales would go in the month sold. And we don't have a March's activity to know what cash sales to put in here, so this is an incomplete column. If this was the first month of service, we could add this up and we would expect $14,000 to come in January and $29,000 to come in February. Can't do this column till we know March sales. If there had been prior sales, if there were sales in December, we might be collecting in January and February from the December activity. But since we're not giving any December activity here, we'll just assume these are the only sales that we need to budget for. Let's leave sales and go into payments. First, let's talk about depreciation. Depreciation is a real expense. You are using up an asset. It is never to be removed from the income statement. However, depreciation is not a payment, so it's not in the cash budget. How does a long-term asset work? It comes out of cash when you buy it. No cash, no cash, no cash, and then cash when you sell it. So the cash activity for a long-term asset is at the beginning and the end. And if you're doing a cash budget, both of those items will be budgeted as an investing activity. The expense comes in the income statement as it's being used up. So when you are moving from expenses to the cash budget, you remove depreciation and you budget for any purchases or any sales in the period those are expected. So when you're moving from expense to payments, there are two major categories. One is cost of goods sold and the other is operating expenses. So those are product and non-product expenses. Cost of goods sold, we first map out when we buy it and then when we pay for it. For operating expenses, we remove depreciation and then find out when is it that it's going to be paid. Let's look at some examples. Cost of goods sold. This particular company, the costs are 65% of sales. They're paid half in the month that you buy it and half in the month after you buy it. All products are bought in the month before they're sold, right? You can't buy it after you sell it. You've got to buy it at some point before you sell it. All right, so here's an example. What if February sales are $50,000? When would you pay for the inventory relating to that sale? So when would you buy it? You would buy it the month before you sold it. So that would be January. What did it cost you? It cost you 65 cents for each sales dollar, 65% of sales. When did you pay for it? You paid for it half in the month purchased, so half in January and the other half in February. And so those payments, the $16,000 in January, February, would go in your cash budget. Operating expenses. Let's imagine that we have a scenario where they tell you the operating expenses are 80% paid in the month used and the rest in the following month, and that depreciation is $10,000. So if February operating expenses were $92,000, what are the payments for these expenses? Well, we have to back out the $10,000 from the $92,000, and so we have $82,000 of payments. When are they going to occur? 80% of them are going to occur in February. The rest are going to be paid in March. So those are the main things: separating revenue from collections,